Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our periodic commentary on economic and market events. Let's get started. This week's Market Insights is devoted to the great inflation debate. Now you might say, what debate? Everybody knows inflation is high, it's terrible, and it's all Biden's fault. Unless, of course, you're a Democrat, in which case it's all Trump's fault, or it's all the Federal Reserve's fault, or the right answer, it's a little bit of all three's fault. But that's not the debate we're talking about. What we're talking about is the great debate between the developed economy central banks. What is that debate? It doesn't get a lot of play in our media because our media is all focused on how horrible the current inflation rate is. But for financial markets and for investors, we need to understand the great debate that's happening between global central banks and what it may mean for investment returns in the coming year. So what is this great debate? Well, if you speak English, which means you're at the Federal Reserve, the Bank of England, the Bank of Canada, the Bank of Australia, then you believe that inflation is not a transitory problem. It has been caused by the central banks in these economies printing too much money. That too much money has hit a dearth of supply because of COVID shortages, and it's creating inflation that could be a long-term problem if these central banks don't act aggressively to nip it in the bud. By contrast, if you're at a central bank that speaks Japanese or French, Spanish, Italian, German, then you believe that inflation is, to use a very hot button word these days, transitory. It is a temporary phenomenon that has come because COVID has required shutdowns in oil exploration, in auto production, in all kinds of parts of the economy. And just as soon as we get things up and running and restarted, then we're not going to have to worry about this inflation stuff. And so these central banks, very different from the Federal Reserve and the Bank of England and the Bank of Australia, these banks are saying, we don't need to change policy. We can keep interest rates extremely low. We may even be able to keep printing money and buying government bonds. So clearly there can be very big differences in investment outcomes depending upon which of these central banks is correct. And in the shorter term, there can be very big differences just because one set of central banks is going to be doing one set of things and the other set of central banks is going to be doing a whole lot of nothing. All right, so what is it that the central banks who are worried about inflation, what is it that they're likely to do? Well, the Federal Reserve just released its minutes from their December meeting, and they laid out pretty clearly what it is they expect to do, and that is they're going to shut down their printing press. And they want to shut down their printing press by March. And as one Fed governor made very clear in a direct quote from one of his speeches, we want to shut down the printing press by March so that we can start raising interest rates in March. Right? And there's a very similar attitude at the other English-speaking central banks. What does that mean? Well, in our opinion, a lot of the extraordinary market returns over the last 2 years have come because the Federal Reserve has been willing to use its awesome power of the printing press to buy government bonds. How does that work and what does it mean? Well, first of all, if you want a real in-depth analysis of this, we posted a Market Insights of this several months ago. And you can go to our website and take a look at it. But as a quick, brief summary, the Federal Reserve is the only entity in the United States that gets to decide how much money is in its own checking account. If they decide to print money, then they say, poof, they wave a computer magic wand and there's more money in their checking account. They use that new money to go buy government bonds, and here's where it gets powerful. The government is able to finance deficits because the Federal Reserve is printing the money and buying their debt. They use that deficit spending to give unemployment benefits and stimulus checks and PPP loans and all the things that has been happening since COVID hit the economy. And that gets the money out into the economy, and it gets the money out into financial markets. Now, the Federal Reserve pumping all that money into financial markets is a huge tailwind that helps increase asset prices, most especially stock prices, bond prices, and real estate. Have you noticed all of those things have really done incredibly well for the last 2 years? Now the Federal Reserve is saying they're shutting down the printing press. That is worrisome, but on a scale of 1 to 10, it's probably a 4, because that means you're going to lose a tailwind. Instead of having the Fed pumping all this new money into the financial markets and driving them higher, they're not going to pump any new money in. All right, you lose a friend, but you haven't yet gotten an enemy when the Federal Reserve is not actively trying to fight the financial markets by raising interest rates. But guess what? With these minutes, they made it crystal clear they intend to. Why is that so dangerous for financial markets? Because there are two things that happen. One, when they raise interest rates, that means that cash becomes more attractive, bonds become more attractive, and that means that there's more competition for the money that would normally go to equities. When interest rates are close to zero, when longer term treasury bonds are yielding less than 1.5%, hey, I'm going to buy some stock. But when you get a more attractive return from cash, when you get a more attractive return from longer maturity treasury and government bonds, that lowers the attractiveness of stocks by comparison. But there's a more dangerous component of the Fed beginning to raise interest rates, and that is how they raise interest rates. How they raise interest rates is they run the money printing machine in reverse. For the last several years, they've been buying bonds. All right? To raise interest rates, they might start selling bonds. So, all right, well, so what? So they sell a few more bonds, maybe interest rates go up a little bit more. But that's not the end of the process. They sell bonds, the money goes into their checking account. Remember, they put money into the checking account, bought bonds. When they run the machine in reverse, they sell the bonds, the money goes into their checking account, and then they hit their delete button. And the money just goes poof. And it's no longer in the economy, and it's no longer in financial markets. So the tailwind that helped push financial markets higher, of all that new money going in, the opposite starts happening. The Federal Reserve is actually hoovering that money out of financial markets. That becomes a potential headwind that is far more alarming to investors than simple raising of interest rates. And those are all the things that the Federal Reserve, the Bank of England, the Bank of Canada, all the English-speaking central banks, that's what they're talking about doing. Meanwhile, the European Central Bank, the Bank of Japan, they're saying, we don't need to do any of that. We can just sit back. We don't have to raise interest rates. We sure as heck aren't thinking about running the money printing machine in reverse and draining money out of our financial markets and our economies. Now that could set the stage for outperformance by these two financial markets. There is one little caveat with that, and that is both Japan and Europe are far more dependent upon sales to China than the US is. We buy from China, they don't buy a whole lot from us but soybeans. But they buy a lot of Mercedes and BMWs and a lot of machine tools from both Germany and Japan. And as China slows, which we think will happen, that's going to be a little bit more of a headwind. So to the extent that the central banks in Europe are not raising interest rates and not printing money, that's great. There could be slightly slower earnings growth, but even so, when you balance it all out, it sure looks like conditions are shaping for particularly European stocks to potentially do better than US stocks. They're starting from an initial valuation that's much lower, and their central bank isn't unprinting money, isn't raising interest rates. Our central bank apparently is. Now that's the short-term aspect. The long-term aspect could be far more important for investors than just Europe maybe outperforming the US by a small margin. The long-term consequence of this great debate is who is correct. If Europe and Japan are correct, then ultimately this time next year, we're going to be saying, hey, all this was a tempest in a teacup, inflation wasn't as bad as we thought, and central banks will still have a primary focus on fighting deflation. So if you go back for the last 20 years, central banks have not worried too much about inflation because after 2008, the fear was a Great Depression. The fear was that the whole global economy could lapse into the kind of persistent price declines that Japan faced, and that made it so hard for Japan to get their economy going and service the huge debt burden that they have. That's been the primary focus for 20 years. Let's not become Japan. All right? If Europe and Japan, if their central banks are correct, then that's probably going to stay the focus of central banks. They'll say, well, gosh, we had this big worrywart thing about inflation, but really deflation's still the problem. If that's the outcome, then that's good for financial markets. Because one of the reasons why financial markets have recovered from every recession really fast is the central banks have not hesitated to lower interest rates and print a ton of money because they were worried about deflation, not inflation. But what happens if a year from now it's the Federal Reserve and the Bank of England and the Bank of Australia? They're the ones that are right. And the inflation was a harder problem to solve, and we had to do a lot of interest rate increases and unprint a lot of money in order to put that genie back in the bottle. That has two really big consequences. One, it means more volatility and maybe hard times for equity investors because they've been draining money out of the financial markets and out of the economy. They've had to raise interest rates more than people are currently expecting. And long term, it could shift their mindset from, if there's ever a problem in the economy, print money, to, we've got to worry about inflation as much as deflation. And when the Federal Reserve is slower to ride to the rescue of the economy and financial markets, that means more volatility, deeper and longer potential bear markets in the future. All right? Who do we think is right? We think it's a little of both. We think neither is going to be completely validated. All right? Because we think if you're thinking about stuff, oil, cars, consumer goods, we think those prices are going to be coming down, and potentially down a lot. Why? Because those prices are indeed up because both we had a lot of money printed, but also we had supply collapse. In 2020, oil production and oil exploration in the US completely collapsed, not because of anything Trump was doing or anything they were afraid Biden might do when he came into office, but simply because oil prices literally went to zero there for a week or two. And at zero, you can't make much money looking for oil, so they didn't. Right? Same thing happened with autos, and all this production came to zero. And restarting that production has been really hard because COVID didn't just go away. And these complex global supply chains have taken far longer than anyone, ourselves included, would have possibly imagined. But if you look at the data, including the PMI data that was released this week, those problems are starting to get resolved. And oil exploration is up 80% over the last 12 months. So for stuff, inflation could come down. And there's another thing that could cause inflation to come down. Remember we talked about China could be slowing. China's trying to crimp property speculation and overburden debt markets in their real estate markets. And that means that home sales are down 30%. That is 1/3 of the Chinese economy. And it's already rippling throughout all of the Chinese economy. Now add to that the crackdown that they did on technology companies, and they've got a big growth problem potentially in 2022. What are they likely to do about it? Well, they're not, the Chinese Communist Party is not going to just roll over and say, well, I guess we're not going to grow this year. They know that their political power depends upon continuing delivering growth to the Chinese people. So they're going to subsidize industries. They're going to say, you guys keep producing, don't lay people off. Well, what do we do with all this stuff? No one's buying it. They're going to export it at subsidized prices. Another big downward deflationary pressure on stuff. But that's the European story. That's the Japanese story. That's what they're saying. But flip over to services, which is about 65% of the US economy. where it's labor is the big thing. We lost 3 million workers in the last 2 years because they retired early, because they got richer because of the stock market and the homes, and also they didn't want to go to work with COVID, right? We've also lost 3 million workers because of the cuts to legal immigration that the Trump administration implemented. So that's 6 million fewer workers than we would have otherwise had. And there's huge demand. We just set a record for the number of people quitting their job because they're so confident that they can get another job at a better compensation rate, right? Labor costs are going to continue to go up. And that means for the 65% of the economy that is services, inflation's going to still be there. So how do you balance, what do you think about financial markets when you have, the Europeans and the Japanese write about 40% of the economy, but the Federal Reserve write about 60? Well, what it means is, in our opinion, is probably rates rise about what the Fed's thinking, 0.75% to 1%. They probably don't have to run the printing press in reverse too terribly dramatically, but they will have to do it some. And that means that you probably have a market pullback this year, maybe a 5-10% decline. We kind of feel like 2000, the last time when the economy was still strong, but the Fed had to run the money printing machine in reverse. We kind of see that as the most likely outcome, and that outcome is going to be okay for the larger markets, because get back 5 or 10 after the great 2 years we've had. Hey, let's not be too greedy, all right? And probably, as you saw, as the Federal Reserve minutes were released, more severe declines in the really speculative names, the technology stocks that are at ridiculous valuations, the cryptocurrencies, and bonds. Why are government bonds below 2% when inflation's running at 6%? Those rates need to come up quite a bit. But you avoid those areas, you go into low volatility, dividend-oriented stocks, all the stuff that's been neglected and left out of the rally for the last 2 years. Maybe you put a little bit more in Europe because that's kind of really cheap relative to the US and earnings growth is exploding. Those all feel like good, reasonable ways to ride out what could be a tough time in some of the hotter names. If we're wrong, then look for the risk is the Federal Reserve and the other English-speaking central banks being right. Because what we do not want to see is them being validated that inflation is really a problem across a broad swath of the economy. If we keep seeing oil prices start to moderate, if we see auto prices start really coming down, then I think we can be assured that at a minimum, it's a minor pullback in 2022, not something more severe. Thanks for joining us for Market Insights. We hope you found it informative. If you did, we hope you can like the video and share it with your friends. If you'd like to see more of our economic and market commentary, you can find it at our website, caravelconcepts.com. Thanks.